Hello and welcome back to All Things Money. I'm your host for the show, David Blain, and we thank you for joining us either on 94.1 FM WNBU or cable TV 10 in New Bern. We appreciate you listening and watching. Today we're talking about some immutable laws of investing, and I've not got beyond the first point, which is a margin of safety. In fact, we started this last show. Now, if you're an astute listener or viewer, you may take something from this, and the fact that this is very important. The fact that we're devoting part of the show last week and a lot of the show today to this margin of safety concept tells you that I think it's very important. It's not something that I made up or invented. It has its roots in Benjamin Graham, sort of the father of value investing. And so we were talking about how most asset classes today seem to be somewhat overvalued. Real estate in a lot of places is becoming undervalued, but in the public markets, and there are some people that think real estate is still overvalued, so you want to be careful. But in the public markets, such as stocks, bonds, things like that, a lot of the assets are overvalued, and so one of the options is to raise cash. Keep your powder dry is my third rule of investing. Be patient and wait for the fat pitch. Well, a lot of times it's very difficult to get this what we call market timing right. In fact, we recommend that people not attempt to do it. It's very difficult to do. But what you can do is you have to be cognizant of the investing environment that you're in. It is possible to, at times when the PE is very high like now, take less risk than normal. Reallocate your funds. Make sure that you're in line with your strategic targets. If you want to raise some cash, by all means, raise some cash. What I'm talking about market timing is sort of the computer binary code, on or off. It's a 1 or a 0. I'm 100% stock or I'm 0% stock. That is the type of market timing that generally is very difficult to do. Most people don't get it right. When you're investing for a margin of safety, we would prefer that you sort of shade the portfolio, in times of high PE. Take some money away from stocks, reallocate it to asset classes that may be cheaper relatively. And it may be cash. You may hold more cash than normal. But anyway, so if you missed the previous segment, go back, listen to it on the web, www.dlblain.com, about the margin of safety. I want to keep continuing on to our second rule of investing. It's called This Time is Different. Sir John Templeton, one of the great investors of all time, defined this time is different as the foremost dangerous word of investing. And what he means by this, you always hear the talk of a new era of either prosperity or a new crisis that is going to wipe things out. And if you stretch your time frame out, or if you include different markets, you kind of see that there are certain rules and that this time is probably not different. Even U.S. housing, if you looked at the last 30 years, ending, say, in 2006, many people concluded, you can't go wrong with real estate. Housing never goes down. Land, they're never making any more of it, et cetera, et cetera. Well, if you looked at a longer time period, or if you looked in other countries around the world, you would realize that home prices do go down, and real estate is not a sure thing. In fact, farmland right now is, on the way up, the price of corn and things like that. But there was a time when you couldn't give away, farmland in Nebraska or Iowa or something. The stuff sold for pennies on the dollar. And so these things go through boom and bust cycles. And generally, it's better to say that, this time is no different. In fact, I did a little study. Well, I didn't do it, but I obtained the data of different what we call crisis events versus the Dow declines and its subsequent performance. And we looked at going back from 1907, the panic of 1907, all these different crises that we looked at. And the average return the day of the crisis was about minus 6.8%. That's a lot. After 22 days, we had a positive 3.7% return. 63 days, 5.2%. After 126 days after the crisis, the average return was 9%. And a full 253 days, which is basically the length of a trading year, 253 trading days in a year, the average return was about 14%. This applies to valuation, as I talked in the first couple of segments, that if at high valuations, this time is probably not different than all the other times. I also want to talk about crisis. We don't have the data for what's going on in the Middle East or Japan yet because it's just happening now. But if we look back at the panic of 1907, the stock market exchange closed for World War I. There was a bombing at the J.P. Morgan office in 1920. The market crash of 1929, which, by the way, the actual crisis event lost about 44% of its money over the space of about a month. 22 days later, it regained 27%, 34% after 63 days, and 46% after 126 days. We look at other crises. Germany invaded France in 1940. Pearl Harbor, 1941. A year later, the markets were up 5%. The Korean War, markets up 26% after a year. Eisenhower had a heart attack in office. Suez Canal crisis, Sputnik, Cuban Missile Crisis, markets up 30% after a year. JFK assassinated, markets up 24% after a year. Martin Luther King assassinated. Kent State shootings, Arab oil embargo, Nixon resigns, Iranian hostage crisis, goes on and on. Iraq war, Gulf War, Oklahoma City bombing, U.S. coal bombing, Iraq war, number 2, war in Afghanistan, terrorist attacks. All these crises that have taken place in the history since we've been recording stock market data, on average, the markets recovered, and on average, a year later, the gain was about 14%. And so when you're looking at principle number 2, this time is different. What I want you to remember is this time is probably not different when it comes to crises or when it comes to valuations, which alludes to number 1, the margin of safety. So we made it through 2 of the rules of investing. We hope you'll join us next week where we'll try to get through some more of the immutable laws of investing. So for All Things Money, I'm David Blain, and we will see you again next week.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.